Welcome to the debate. Today we're tackling really one of the most fundamental choices facing anyone who finds themselves with a bit of extra capital. It's that classic financial fork in the road. Do you take that money and aggressively hammer down your mortgage debt, or do you deploy it into broader investment opportunities, really trying to leverage the power of compound returns?
Exactly. And this isn't just a simple math problem, right? It goes deeper. It's really a question about your philosophy, your tolerance for risk, and ultimately your long-term financial strategy.
That's the core question we're debating today. Which path provides the better route to long-term financial freedom? Is it the, let's say, mathematically guaranteed return you get from wiping out debt? Or is it the maximizing strategy, leveraging capital for potentially much greater growth? I'll be arguing that prioritizing investment is, well, it's the route of acceleration. It's about maximizing opportunity cost and using capital leverage to build wealth faster than, frankly, any debt reduction strategy ever could.
And I'm approaching this from, let's say, a different angle. While the lure of maximization, getting the absolute highest return, is undeniably strong, I believe the certainty, the mathematical certainty of the return, and the profound sort of structural financial security you get from extinguishing your largest liability, the mortgage, I think that has to take precedence. My argument really hinges on minimizing risk, securing that guaranteed return, and creating an absolute ironclad financial foundation, a foundation that lets you deploy capital later, maybe from a position of absolute strength, not out of necessity.
Okay, so my core position for prioritizing investment, it rests squarely on two principles: opportunity cost and the velocity of wealth creation. We really have to look past just the monthly payment and focus on the cost of that capital over, say, 30 years. Now, if we assume the existing mortgage is fixed at a relatively low rate and based on the material we looked at that often falls, somewhere in the 3% to 5% range, then that money, frankly, is profoundly better utilized when it's strategically invested in assets that, historically anyway, can yield significantly higher returns. Retaining the mortgage, in this scenario, is basically using cheap, fixed-rate financing to control appreciating assets. This allows for faster wealth creation through, well, appreciation itself, potential cash flow, and key tax advantages. And importantly, we can't ignore the long tail of inflation. Every single year, inflation effectively makes fixed-rate debt cheaper. That 4% interest rate you're paying today, it's being paid back with future dollars that have less purchasing power, making the debt itself less economically urgent to just wipe out.
That's a compelling argument, especially when you focus on historical potential. But I'd frame it quite differently. While you emphasize potential returns, I'm prioritizing certainty and the concept of a real, guaranteed return. Paying off the mortgage gives you a guaranteed return equal to the exact interest rate you save. And this is the critical part. It's a return generated completely without exposure to market risk, without volatility, without the catastrophic timing failure that can absolutely sink an investment portfolio. For someone who is maybe naturally risk averse or perhaps, approaching major life transitions like retirement, where stability is just paramount, this strategy is, I think, unmatched. You completely eliminate speculation. That guaranteed interest saved becomes a foundational risk-free internal rate of return for your household.
And, beyond the strict numbers, think about the immediate tangible benefit, the elimination of what is usually the largest single monthly expense. That frees up cash flow instantly, powerfully, providing a hedge against economic uncertainty, a benefit that, honestly, many people rightly value more highly than chasing speculative higher risk returns.
Okay, I understand the certainty argument, I really do. But doesn't that certainty essentially lock you into a rate of return that, let's be honest, we know is historically too low to adequately combat likely future inflation targets? Let's get specific for a second. If your mortgage is at 4%, right, and you choose to aggressively pay it down, you're actively choosing a risk-free 4% return. But if historical market averages suggest that, even conservatively, a well-diversified portfolio could potentially net you, say, 7% over the long term, aren't you accepting a 3-point drag on every single dollar you dedicate to that debt payoff? Over 20 years, compounding that 3% difference, well, it turns into a massive divergence in net worth. To deliberately cap one's long-term potential at such a low, fixed rate seems like a significant missed opportunity for wealth compounding, especially, for those with a longer time horizon ahead of them.
But you're focusing on the average. And the average, as we both know, is absolutely not a guarantee. Markets are cyclical. We know for a fact that periods of steep recession exist. What happens if you invest your capital right near a market peak? You might face a decade just trying to get back to even, losing those crucial early years of compounding power. Whereas the interest saved by paying down the mortgage, it's locked in, it's reliable, it's entirely independent of global economic conditions or stock market swings. And furthermore, when you talk about inflation eroding the value of the debt, which is true, you also have to acknowledge that inflation also erodes the real value of your investment returns and the real value of that 4% guaranteed return from paying off debt. So if inflation is running at, say, 3%, your guaranteed 4% is only providing a 1% real return. Now, is chasing a speculative 7% nominal return, which might only be 4% real, truly worth the risk of potentially losing principal when the alternative is securing a structural hedge against things like income loss? Security in this context, I argue, is superior to purely probabilistic maximization.
Okay, but we need to pivot here slightly to the mechanics of actual wealth growth, specifically the powerful tools of leverage and asset multiplication. This is particularly relevant in real estate, where this whole dilemma often comes up. I'm sorry, but I just don't buy that paying down a low-rate liability is the optimal use of capital for someone focused on growth. Let's use that classic $50,000 example. If you take $50,000 and put it toward your existing mortgage principal, okay, your net worth barely budges immediately, and your monthly payment might drop by only, a handful of dollars, relatively speaking. But if you use that same $50,000 as, say, a 25% down payment on a new income-producing asset worth $200,000, well, you've just leveraged your capital 4-to-1. Instantly, you now control an appreciating asset base of $200,000, it's potentially generating cash flow, and you're utilizing the interest deduction perhaps on a much larger pool of debt. This is how wealth is often multiplied by using capital as an engine to control more assets, not just as a solvent to extinguish relatively cheap debt.
That's a very compelling description of asset multiplication, yes. But have you fully considered the inherent and often crippling rise in financial vulnerability that comes hand in hand with heavy leverage? While leverage absolutely maximizes appreciation potential, it dramatically amplifies risk if your income gets disrupted or the market turns sour. The source material we reviewed explicitly warns about becoming asset-rich but cash-poor. And let me tell you why that really matters in practice. If all your available capital is tied up in leveraging new deals, what happens when a real emergency strikes? A required major repair on a rental property, maybe a significant unexpected tax increase, or, God forbid, a personal job loss. You simply lack liquidity.
You might be forced to sell assets in a downturn the worst possible time. Or, even worse, rely on high-cost borrowing like a cash-out refinance, maybe at a terrible rate, just to cover basic operating expenses. Aggressive debt payoff, on the other hand, naturally provides that liquidity cushion by freeing up substantial monthly cash flow. That enables an individual to survive financial shocks without having to touch their core asset base.
Right, the liquidity argument is fair. I'll grant you that. But I'd argue that's potentially a failure of risk management, not a fundamental structural argument against using leverage intelligently. A smart investor surely maintains a reasonable cash reserve while deploying capital for growth. They strike a balance that recognizes that, well, idle cash sitting around is actually a drag on long-term growth. The fundamental mistake, in my view, is sacrificing potentially high yield purely for immediate cash flow certainty. If your primary goal is building significant long-term wealth, the higher expected return from investment generally outweighs the certainty of the debt payment savings. And let's quickly touch on the tax benefits again. The mortgage interest deduction, even though it might be limited for some, still makes that debt effectively even cheaper on an after-tax basis.
But the value of that tax deduction shrinks proportionally as the loan balance decreases, right? It becomes less and less impactful over time. And when we discuss the practical implications of being asset-rich but cash-poor, we're not just talking about poor risk management in some abstract sense. We're talking about the reality that life inevitably necessitates liquidity. Unexpected things happen. And I want to transition here to the behavioral side of this debate, because it's often dismissed as, secondary to the pure math. But I think it's absolutely crucial. Finance isn't purely mathematical. Psychological factors are critical drivers of sustained financial success or failure. We know that some individuals genuinely place a higher internal value, a higher utility, on the mental clarity and the sheer relief that comes from being completely debt-free than they do on chasing that statistically projected, maybe extra 2-3% of market return. Eliminating that enormous monthly mortgage burden provides a structural hedge against career risk, yes, but it also allows a person to approach life with significantly less underlying stress. And that stress reduction, well, it has tangible health and well-being benefits that the spreadsheets simply fail to capture.
Look, I fully acknowledge the profound peace of mind that people associate with eliminating their single largest monthly obligation. I get it. But if the defined goal is maximum long-term security achieved through optimal growth and reliably beating inflation over decades, is prioritizing that immediate emotional comfort over a maximal strategic growth plan truly serving the individual's ultimate long-term financial destiny? For those who choose the path of accelerated wealth building, maximizing leverage and accepting a higher but manageable debt load is often a necessary, calculated trade-off. The challenge becomes managing the psychological discomfort, perhaps, not completely sacrificing the optimal mathematical strategy just to, feel better in the short term. Arguable, the long-term security provided by ending up with a much larger investment portfolio ultimately offers a superior, more robust form of peace of mind down the road.
Superior peace of mind if you get sustained, successful market performance for decades without major disruptions. The security I advocate for by paying off the house is delivered today. It's a certainty, not a probability. And I'd actually push back a bit on your framing. The psychological benefit of zero mortgage debt isn't just comfort. I see it as a profound strategic advantage. If your house is fully paid off, your necessary income floor drops dramatically. That gives you much greater career flexibility. Maybe you can take a more fulfilling, lower-paying job, or weather a significant pay cut, or even have the option to retire earlier than you otherwise could have planned. That kind of flexibility is a form of wealth in itself.
Okay, and of course we should probably briefly mention that there is, the balanced approach out there. Many people find success by making, say, partial prepayments on the mortgage, while still investing a substantial portion of their extra capital elsewhere.
Yes, that is a reasonable pathway. Absolutely. But even a balanced portfolio like that requires a primary philosophical anchor, doesn't it? At its core, that strategy still demands a decision. Is the underlying goal debt elimination as fast as reasonably possible to achieve maximum security? Or is the main goal capital deployment for maximum potential yield, with debt management simply being a necessary operational aspect? Because every dollar you commit to one side is by definition a dollar you've taken away from the other. So to summarize my position, paying off the mortgage provides unmatched structural financial security. It offers a guaranteed, risk-free rate of return equal to the interest saved, and it delivers profound emotional and career flexibility. It is, I believe, the preferred, prudent route for those who are generally risk-averse, those who prioritize stability above all else, or those who simply recognize that the security of a guaranteed return today outweighs the pursuit of potentially higher but speculative growth tomorrow.
In my position remains that, intelligent investing requires the active utilization of opportunity cost and leverage. When fixed-rate debt is relatively cheap, capital must be allowed to work harder in vehicles that have the potential to significantly outpace both the mortgage interest rate and long-term inflation. This approach accelerates wealth accumulation, sometimes dramatically, over the long term. It maximizes potential and utilizes the full scope of available financial tools for the growth-focused investor, especially one who has a decades-long horizon ahead of them.
I think we can certainly agree that there is absolutely no single, universal, correct answer here. The best choice depends entirely on an individual's specific goals, their age, their personal risk tolerance, and, critically, the active role they actually intend to take in managing and growing their investments.
Exactly.
And hopefully, understanding the detailed arguments for both guaranteed security on one hand and optimal growth on the other empowers our listeners to choose the financial strategy that truly aligns best with their unique definition of long-term financial freedom and success.